Sign in when this sheet of paper comes around, please. Hey, come in. Come in. Okay, folks, chapter 13 is a hard chapter, and looks like we have a few people out today. If they're not studying business law somewhere else, people like Jessica trying to study it here. Anyhow, uh, business law will be fine. You'll do fine. But try to don't ever give up one class for another. Just get behind in the other. What have you. Uh, I take each one as they come. All right. We had a lot of homework for today, and I think I've left all my pens. What was your homework problems, Alexandra? Let's look at some things in chapter 13, folks. We need a whole lot of practice. Hope you have practiced these.
Problem 1A, 2A, 4A. Exercises for the previous time.
Is Carlos and Millie lost somewhere?
She also goes business law. She said she goes business law.
Oh, she's business law too, eh? I'm gonna have to fuss at Mr. Lilly for giving a test on the wrong day. Okay, now chapter 13, folks, corporations. We looked at characteristics, so let's don't look at those anymore. Those make that multiple choice question. Corporations, we've got to learn how to issue stock. We've got to learn how to issue stock with a premium, which is above par value and above stated value. We've got to learn how to buy back some of our own stock called treasury stock. We've got to learn a little bit about a stockholder equity section and a retained earnings statement. So there's a lot in this chapter. You had one test in here, and it should have been fairly easy compared. And this next test will probably be the hardest test you've had in accounting. All right, and then the last couple of tests will get easier again. But this second test is tough. So I encourage you to study. Now, how about Cengage on chapter 13? How many of you are at least 80% finished? 100%? Jessica, what percent are you?
86.
80-some percent? Okay, hopefully all of you have started chapter 13 and getting up to around at least 50%. Don't put that off either, okay? Okay, now what exercise did we not cover last Thursday? Kelly, what were some of the exercises? Yeah. Thirteen?
Yeah, exercise.
Is that the only one? You don't know? Yeah, okay. Now, the first exercise, dividends per share. I really feel like we practiced that enough, okay? And then need to get up to issuing stock. That was exercise 3 and par value stock. All right, look at exercise 3, whether you had this or not. On October, uh, a Marvel contractor issued for cash 400,000 shares of $10 par stock at 18. And November 19, it issued 50,000 shares of preferred stock, uh, 75 par at 80. Journalized the entries. Now, that is a generic entry. For number 3, what entry do you think you would make for that? Anybody? All right, let's do some multiplying. Okay, for the common stock, let's multiply 400,000 shares times 10, and then multiply 400,000 shares times 18. Now, $18 a share is the cash you're getting. So you debit cash for how much, Kelly? 7,200,000. All right, now if you multiply 400,000 times 10, you get 4 million, don't you? You will credit common stock for 4 million. Now that difference there is what? Paid in capital, okay? So we've got to get these generic entries down, but there will be some harder entries for stock dividends and so on. All right, so we debit cash for the $18 we received. We credit common stock for the par, and we credit paid in capital in excess for the difference. Now, you'll have a lot of entries like that. There's no need, of course, to miss them. And then the preferred stock, if you multiply $80 times 50,000 shares, what do you get? $80 times 50,000 shares. Is that 4 million? All right, that's the cash you receive, 4 million. And if you multiply 75 times 50,000, what do you get? That's what you're going to credit preferred stock for. And what is that difference? All right, that difference is always going to be paid in capital in excess of par, common, paid in capital in excess of par, preferred. All right, those are generic entries for selling common and preferred stock. That is ownership in a corporation. Whoever bought these shares now are part owners of that corporation. All right, we'll get down to number 4, no par stock. Now, no par stock, here it says for cash, 1 million shares of no par common with a stated value of 25 cents a share. We're going to sell it at $1.20. And on August, we issued 10,000 shares of preferred stock, $15 par. Now, this is going to be the same entry. All right, this is par stock, this is no par stock. But when you put a stated value on it, the interest is the same. If no par stock has a stated value, the entry is the same. So you debit to cash for the selling price, you credit to common stock for the par, and you credit paid in capital, excess of stated value for the difference. All right, preferred, this was par value, cash, credit preferred stock, credit paid in capital. Now this one, if it did not have a stated value of 25 cents a share, you just debit cash $1,200,000 and you credit common stock $1,200,000. That would be no par stock with no stated value. So those are common entries throughout this chapter. All right, number 5. This was assigned for last Thursday, and we're going to issue 30,000 shares of $80 par common stock at $112 per share. So what do we get now? That we acquired land in exchange for 30,000 shares. All right, multiply 30,000 shares times 112. That's the market value of that stock. How much?
3,360,000.
I know. Look at this one. That's what you debit land for. 3,360,000. Common stock is at par, 2,000,004, and the difference is paid in capital in excess of par. So you're getting land instead of cash. Only difference. So if you start your own corporation, you can put in your land, you can put in your truck, you can put in your computer, whatever you want, and give yourself stock for it. Now you also had number 8 signed for last Thursday. All right. Workplace Products, a wholesaler of office products, was organized on July the 1st, authorized 50,000 shares, preferred stock 2%, $40 par. You authorized 750,000 shares of 7%, let's see, $7 par common stock. All right, we issued 400,000 shares of common stock at par for cash. Now, what is 400,000 times 7? How much? All right, say, what will we debit for that 2,000,000 some thousand? Debit cash. So what you sold it for, yeah, and credit what? You sold it at par, right? So you just credit what? Just credit common stock. All right. If you sell it at par, there's no problem. Debit cash, credit common stock. All right. Now we're going to issue another 1,000 shares of common stock at par to an attorney and pay him legal fees for organizing a company. Evan, what do you think you would debit when you give somebody stock for legal fees? Anybody? What would you debit?
Organizational.
All right. Now that's another common entry you may see with corporations. Debit organizational expenses and credit common stock. In the 3 forms of business, corporations are the same, or an LLC, I guess, limited liability company. But partnerships are the most aggravating for tax returns and everything else. Corporate tax return is not that hard. It's like an income statement and a balance sheet and so forth on a tax return. And the corporation pays their own taxes. Dividends that they pay the owner is, of course, taxed. All right, so that's where the double taxation comes in, which is a disadvantage of a corporation. All right, moving on down, we issued 80,000 shares of common in exchange for land, building, and equipment. All right, so we're going to have to debit land and building and equipment. Number 7, does anybody have the paid-in capital figured up on that one? How much? All right, it looks like Miss Kelly has done her homework, okay? And maybe that's why Miss Kelly made 115 on the last test. Okay? Doing homework helps. You debit the land for what they told you. You debit the builder for what they told you. You debit the equipment for what they told you. And the stock is $7 par. 7 times 80,000 is 560. And then, of course, the difference. Add these, subtract 560, and you'll get paid in capital of 160. Okay. We issued 25,000 shares of preferred stock at $44 a piece. Now that preferred stock was on the books for 40. So multiply 25,000 times 44. What is 25,000 times 44? All right, Dylan, what would we debit for that? How much? All right, you credit stock for how much? All right, we sold it for 1,100,000. We credit the stock for 1,000,000, and that leaves us paid in capital 100. Again, these are just stock transactions, ordinary stock transactions, which is a very important part, which is the beginning of the chapter. All right, that's what these exercises. Now, interest for a cash dividend, exercise 9, that was assigned for last Thursday. And we're going to pay 135,000 cash dividends on common stock. Journalized entries occurred on each date. There's the date of declaration, the date of record, and the date of payment. The middle one does not have an entry. So on the date of declaration, Jessica, what would we probably do?
Stock dividends, and then stock dividends payable.
All right. Sounds good, except leave that word stock out. It is not a stock dividend. Okay.
That's what it has on it.
Does it have stock dividend?
That's what it has on it.
No, it's a cash dividend. 9. Now, Cengage, you will have a stock dividend. We'll look at those in a minute. But these are just cash dividends. All right, not stock, and credit cash dividends payable. Okay, on the date of payment, we know how to take care of a liability. That's a liability. So on the date of payment, Alexander, we just debit what?
Debit, cash dividends payable, credit, cash dividends. Debit or credit cash.
Right. All right, the 3 dates. Date of declaration, date of record, date of payment. All right, so that is a cash dividend, which is an important part of the chapter. And we learned how to calculate dividends last week. All right, your next exercises is 13, but we should do 19. And this will be what Jessica was talking about. All right, Senior Life Company. The following account balances appear on the balance sheet of Senior Life. Common stock, 800,000 shares authorized, 500,000 shares issued. That's what's important, issued. Paid in capital in excess of par, common, 1,000,000, and retained earnings, 33,500,000. The board of directors declared a 2% stock dividend. Now multiply 2% on the number of shares you had. How many did you have issued? All right, what is 2% of 500,000? I'm on number 9. Number 10, dear. Number 10. It was not assigned. I just want to go over it. Yeah, number 10. Probably don't have this one worked, Kelly. All right. What is 2% of 500,000 shares? All right. We're going to give our stockholders 10,000 shares of stock. That's what we're going to do. We're going to make a journal entry for it. All right. It's got to come from somewhere. So I want you to see this entry. $2% is 10,000. Now the par value is $13 a share, right? 13 times 10 is 130. So stock dividends. Okay. Now the par value of that stock is $4. That's 40,000. And we even have paid in capital in excess of par for a stock dividend. We have paid in capital on preferred stock, common stock, stated value stock, stock dividend. All right. Jessica, I'm going to pick on you. Read this line.
Stock dividends district.
All right, she got it. Stock dividends distributable, that word, the way it's put in there. Some books, students didn't like to have to say that. Some books it went, stock dividend to be distributed, all right? Instead of using the word distributable, okay? Okay, that's a tongue-tied word. So we will have entries like this on the next test. Stock dividend. So you got to record stock dividend at par. You've got to credit stock dividend distributable at, market value, debit. Par value, credit. The difference, paid in capital. All right, we got to get this off of our books. What do you think we would debit? Get this off our books, we debit what? Stock dividends distributable and credit common stock. And that should be right there for the 40,000. Okay, so no stock dividends. We should have them in some problems. Now, a stock split does not do anything to hurt your equity statement, balance sheet in any way. If we have, this is one that my pen won't write on. If we have 10,000 shares of stock and we have 2 for 1 split, now we have how many shares? 20. Now, if it were $20 par, now it's what par? 10. You make a memorandum entry, that's all. There are no debits and no credits for a stock split. Okay? No debits, no credits. But be careful. If you have a stock split, if you had 10,000 shares, you had a stock split, now you got 20. If you bought 2 of them back trading stock, you got 18. The 18 is what you pay a dividend on. All right, so let's skip the stock split. Now, number 13 was assigned for last Thursday. Okay. Selected dividend transactions, and we do have a stock split there also. Split the common stock 2 for 1, reduced the par from 80 to 40. After the split, there was 150,000 shares. You simply make a memo entry. That's all. Declared semi-annual dividend of 75% on 18,000 shares preferred stock and 25% on common stock. Well, 75% of 8,000 is easy to calculate, or 18. But now, 28 cents on how many shares of common? After the split, there was 150. So let's go down to exercise 13. All right, I'm just going to show you this one overall. A memorandum entry. Now, cash dividends, your preferred dividend and your common dividend adds up to be 55.5. Cash dividends payable. Pay it just like we did a minute ago. Alexander did this entry. All right, we got cash dividends again and cash dividends payable. Well, let's check out the stock dividends. We had that one a minute ago. All right, we're giving a 5% stock dividend, 150,000 shares. Somebody multiplied that, 5% times 150. I believe that's 4,500.
500?
I did miss it, didn't it? Yeah. I was looking at something different. Yeah, I was thinking that's 3. That is 7,500 shares. 7,500 shares times 52. That's 390. So we debit our stock dividend 390. We credit our common stock for par. 7,500 shares, really $12, or the difference is 90,000. But the par value is 300. So that's a stock dividend. And more cash dividends payable, but now you got to be careful. Go down to December 31st. declared semi-annual cash dividend of 75 cents on the preferred and 14 cents on the common stock before the stock dividend. In addition, a 5% common stock dividend was declared on the common stock outstanding. All right. I think we took care of that 31st and that 31st. And yeah, we took care of all of it. And then distribute the stock, common stock, stock dividend, distributable debit and credit common stock. Good little exercise to know. Okay. Is that what you were talking about? The stock dividend you had on Syngate?
Yeah.
Okay. Okay, Jessica, I hope you are starting to understand it better. All right, and the next topic is on page 662 of your textbook. All right, now we're going to work one problem, then I'm going to let you work a problem in class on treasury stock. Treasury stock, the company buys back their own stock for whatever reason. Maybe they think they can make a profit on their own stock by buying it back. Maybe they want less shares outstanding, so they have more control. If you own 51% of a company, then you own it. I mean, you control it, don't you? Amazon, who do you think owns 51%? Amazon, have you not heard about him in the news? What is it? GEBO or something like that?
Bezos.
What?
Bezos.
Bezo? BEZO? Something like that. He started Amazon and they say he's the richest man in the world. Used to be Bill Gates that started Microsoft. Then Apple came way up there. Two friends started Apple in a garage. And they became wealthy. And I don't know where the guy started Facebook, but Facebook's all over the world. Okay? He's wealthy. And Twitter, I don't know who started Twitter or Instagram and so forth. How many of you all use Instagram and Facebook? Okay. All right. So we're talking about some big corporations in the tech industry that's been started during your lifetime. Treasure stock, you buy back your own stock. Number 14, this company bottles and distributes spring water. On February the 11th of the current year, Lava Lake reacquired 180,000 shares of its common stock at $17 a share. Simply multiply. Multiply 17 times 180,000. And what are you going to debit? What did you buy?
Treasury stock.
You bought treasury stock. That's what you're going to debit. And you're going to credit cash, right? Okay, so let's don't make treasury stock hard either. All right, now this is what, 14? All right, that's all you do. Debit treasury stock, credit cash. But now, how much did we pay for that treasury stock? 17. Now, what if we sell it for 20? What's that extra $3? Paid in capital. Don't worry about par value on treasury stock. It's what you pay for it. It's what you sell it for. All right. We sold some for $20 a share. And later we sold some for $15 a share. All right. We know we're going to debit cash. And we're going to credit treasury stock. Debit cash for the 20, treasury stock for the 17, and paid in capital for the 3, for the difference. All right, now we're going to take a loss. Debit cash, debit paid in capital, all right, for the loss of $2 a share, and credit Or you're gonna credit. You're gonna credit treasury stock, that's what you sold, isn't it? Credit treasury stock here, you're gonna credit treasury stock. I don't know why that part is left out. You're gonna credit treasury stock for how much? 510,000? Credit treasury stock for 510,000. All right. Now I want you to look at that third entry. Very important. Now here we had a big gain, so we had $200,000, 270,000 in the kitty. Yeah, we could take a loss of 60, take it out of that 270. What if you had this loss of 60 first? What if you didn't have this 270,000 gain? Then you would have to credit retained earnings. I don't know if your book will show you that or not, but you will credit retained earnings. Now I want you to take about 4 minutes and do what you can with exercise 15. Especially transaction A, journal entry A. All right, make me about 3 entries for exercise 15. Everybody jot down something. Somebody didn't sign in. Who did not sign? Your entries will be something like you see here on number 14. Okay, so what do we debit, Alexander Fanning? What we debit for the first entry?
You'll debit treasury stock for $2,550,000,
And credit?
and you'll credit cash for $2,550,000.
All right. An entry that you'll see again and again, it's always the same when you buy treasure stock. You debit treasure stock and you credit cash. Okay. Eva, do you have the next entry? How about Malika?
So, debit cash, but we multiply by
Yeah.
124,000, we multiply by 0.6.
Right, and you debit cash for how much?
Percent 4,000.
All right, and credit treasure stock for how much?
I didn't know.
Oh, okay, so let's look at it. All right, 24,000 times 60 is 1,440,000. The treasure stock you only paid 51 for, so you credit it for 1,224,000. What is the difference? $9 or 216,000, no matter how you get it. You credit paid in capital from the sale of treasure stock. Okay. And Jessica, do you have the third entry?
Cash is debited 1,008,000. Treasury stock is credited for 918,000, and paid in from sale is credited for 90.
Now, I don't know why they're leaving off. The treasure stock paid in capital was how much?
90,000.
90,000, okay. Right now, the other questions here I want to draw your attention to, on, I guess, number 15, was the balance in paid in capital from the sale of treasure stock. Well, that's easy. We had 216, and I believe you said we used how much, 90?
Yeah.
216 minus 90.
It's
Well,
plus 90.
wait a minute, they were both pluses, weren't they?
Yeah.
They were both pluses, so you have 306. All right, and what is the balance in treasury stock? Well, ever how many shares we had, and ever how many we sold, you gotta keep up with them. But do we just have 18,000 shares left at 51 a share? The balance in treasury stock account is reported as a minus. A minus, you can do that in retained earnings or on the stockholders' equity section. We'll have to look at that later too. All right, so we went through a couple of treasury stock transactions here. And if you want to practice more, do number 16 on your own. Now we're going to go to number 18 and 19. Now we're going to practice a stockholders' equity section this morning. So please pay attention to number 17 is part of an equity section, but I'm gonna go straight to 18. Now, folks, look at this. You can organize these two different ways. So you gotta pick one to organize them. This one is as good as any. You've got paid in capital as your stockholders' equity. You got common stock. 80,000 shares authorized, 68 issued. This is your excess at par on common. All right, now here's your balance and common stock. Now you're gonna, from sale of treasure stock, 115. That's paid in capital. You add that on. So now you got 3,447,000 paid in capital from treasure stock. Then you got retained earnings. You got total. And treasure stock is a negative or a minus. Remember, this was a gain from treasure stock. Here is the value of your treasure stock that you have left, and you subtract it. So your equity section is 23,676. and you add that to liabilities to equal assets. Assets is equal liabilities plus stockholders' equity. Okay. All right, now look at the information on number 19. You've got common stock, paid in capital, and you got some preferred stock and retained earnings and treasury stock common. All right. Now, if you read this, all right, 50,000 shares preferred and 300,000 shares of common stock are authorized. There are 24,000 shares of common stock held as treasury stock. Preferred stockholders' equity section of the balance sheet. All right, now common stock, somebody divide 36 into 10,080,000. Divide $36 par into 10,080,000. What do you get? How much? All right. 280. There was 300,000 shares authorized. I don't know how many we sold. We'd had to sell that many, Kelly. 36 divided into 10,080,000. But then did we buy some of those back? There's 24,000 shares of common stock held as treasury. So how many of those are outstanding, you see? All right, so take a minute, use this as a model, and try to do a stockholders' equity section on a plain sheet of paper. All right, you have about 5 minutes. And you at home, please do the same. All right, we've got 18 on the board, and I want you to do 19. Put it in some kind of format like number 18. Finish, William? Wonder if anybody has a final total. Kelly, you got a final total? You wanna do 560? How much you think? A couple of you guys have. All right, let's see what we have on this one. Some of you are part way finished. Few of you are all way finished. All right. Preferred stock goes first. You didn't, that's okay on this for this time. You had 50,000 shares authorized, 48,000 shares outstanding. You can always divide this by par and find out how many shares are issued. You had excess over par, so you had paid in capital from preferred stock. And common stock, 280,000 shares is what Kelly calculated a minute ago. Excess over par, paid in capital, common stock. Now we sold some treasury stock, got this much money. All right. Now when we take our paid in capital, plus our retained earnings, we have 90 million went away. We subtract out 24,000 shares of treasury stock, that cost 89,100,000. So what you had, Kelly?
I didn't do.
What?
I forgot about the.
Okay. Dylan, you matched Kelly, so you must have made the same mistake Kelly made.
That's what
All right, there it is, folks. Finish it out. Take a minute. Don't worry about business law. You all that attended class today will do better on that business law test than those who skipped to study for it, okay? I predict you'll do better for those who are out studying. Okay, a couple more exercises I want to look at. I want to look at number 20. And retained earnings is 71,684. But we know this is part of your balance sheet. Now, if we were doing an income statement, we got to do a retained earnings statement, then the balance sheet. Just like we do a income statement, a capital statement, then the balance sheet. All right. So that's why I wanted to show you number 20. That's a retained earnings statement. And I told you before, it's just like a capital statement. Beginning plus net income minus dividends gives you ending. All right. So if this were capital, this would be drawing, increase in capital, be the same thing as a capital statement. So remember, beginning retained earnings plus net income minus dividends gives you ending retained earnings. All right, I want you to look at number 23 and 24. I want to show you number 23, then I'm going to ask you to do number 24. All right, this is EPS. EPS is important also, but you'll get this in a later chapter in chapter on ratios. But right now, it's net income minus preferred dividends over what? Average number of common shares outstanding. So this is net income minus preferred dividends over 40,000 shares is 730. Remember, this is net income minus preferred over, all right, over 40,000 shares. Net income, the formula's right here. Net income minus preferred, put a line between there, 40,000 shares. And I can't make a line, so. All right, so let's see what you can do with at least year one, maybe year two for exercise 24. Do year one, maybe year two for exercise 24. Year one, does anybody have an answer? How much? $1.83. Did anybody get year two? $24.
It goes year 3.
The what?
It goes
All
3,
right.
2, 1.
That's what I was wondering. Year one. I can't make any sense out of this yet. Let's see. You were doing year one. You get $1.83 a share. Year two, Kelly, did you say 07? I didn't hear the 7. 307. Okay. So that's not going to be a burden on you. EPS. Okay. So now we've covered some of the important exercises, covered all topics in the chapter. Selling preferred stock, selling common stock, giving a stock dividend, paying out a cash dividend, EPS, the stockholders' equity section of the balance sheet, and just a quick look at a retained earnings section. That's what's in the chapter. And we've looked at it in exercises. Now, what is your problems for homework for today? What was that? 1 and what? 1A is dividends, like we calculated in class. 2A is selling stock. 4A is selling stock. I want to add 3A to that. The only thing I'm adding to these three problems is 3A. So now you got 1, 2, 3, and 4A. If you get time, read chapter 14. So that's your homework. So you've got 20 minutes to get out here and study business law. Okay? We'll call it today. Hope you folks at home kept up.